And thanks all of the individuals that are attending. This is the fourth year I've presented for CAI. It's a pleasure. So who will benefit from this presentation? Okay. Who have previously struggled at promoting rolling financial forecasts as an advance to the annual budget, and managers who intend to champion performance-based budgeting and need a compelling call to action. And the reason I have champion in quotation marks, it's just been my observation that although it's really nice to have senior executive sponsorship for initiatives, too often they're preoccupied with short-term priorities or firefighting. And it's often managers that are 1, 2, 3 levels down from the senior C-suite that kind of have fire in the belly, passion. They ask themselves, how long do we want to perpetuate using some of our, traditional methods and techniques? And those are the people I really like to appeal to. I hope there's a few champions listening in the audience today. Start with 3 key questions. What, so what, and then what? And the what tends to be looking at historical information, what do things cost, where do we make money, and so forth. The so what is, once I have information like that, what's relevant, where do I pick? But the then what, I think, is the key question, and that's what this presentation will be about, because what's the impact in the future when we make changes, whether it's budgeting, whether it's forecasting, whether it's what-if analysis, what will be the impact? This is a diagram that I created for IFAC. IFAC is the International Federation of Accountants out of New York City. They're like the United Nations of accounting institutes. They have 180 members like the AICPA. And it's what I call my taxonomy, like in biology, animal kingdoms, plant kingdoms. And you can see there are the 3 big kingdoms: tax accounting, financial accounting, managerial accounting. And we're going to just focus on managerial accounting. The inputs are universal for all of them. There's always going to be some sort of source data, financial data coming in, like from a general ledger, and then there's non-financial information. Regular cost accounting, I'll fill this out a little bit. That's pretty much for the financial accounting, GAAP, cost of goods sold, and so forth. When we get to managerial accounting, there's really 2 parts. There's the historical looking back, cost reporting and analysis, profitability reporting, variance analysis, and the like. But what we're really looking at is that blocks on the right: decision support, cost planning. That's really where driver-based rolling financial forecasts fit in. And at the bottom, you can see the value of the information, in my mind, goes from low to high as we move from left to right. Through these 5 elements. First, we're going to have to do some basic setup of costing, then describe what's really broken with traditional budgeting. Then they shift towards really the rolling financial forecasts, and they should be driver-based. I'm going to put my industrial engineer hat on, talk a little bit about resource capacity planning because that's key. And then something I hope everyone will stay to the end, because I'm just so frustrated with the slow adoption rate of all these various methods, not just the rolling financial forecast, but of others. And we'll have to talk a little bit about what do we have to do to get buy-in and overcome resistance to change. So let's start with the basics. This is meant to be a humorous slide. This is what I call the 6 broad eras over history of management accounting. Of course, we start with, cavemen and cavewomen, rocks and stone piles. Then in 1496, some of you may be familiar with Luca Pacioli. He is the first one that actually documented double entry bookkeeping. Then we reach basically the late 1800s, early 1900s, the industrial era. Frederick Winslow Taylor, if you're an industrial engineer, he's sort of a hero, with scientific management, production, and so forth. But you may not know that Alexander Hamilton Church was an accountant who accompanied him and created cost accounting. Then we have what I consider to be sort of a setback, because in the Depression in the 1930s, part of it was responsible or due to lack of really rules, and that's when the SEC came in with GAAP and how do you quantify inventories and so forth. The reason I call it a setback is because it was a distraction from management accounting. Now we reach the 2 that are of interest to me. First, there is really the consumer-led, which is not just calculating product costs, but going below the gross product profit margin line to channel and customer profitability. And there's a reason why I'm referring to this, because we'll be coming back for these as the basics in order to have the consumption rates to basically calculate the future, which is the predictive accounting, which is really a shift of emphasis from past looking backwards, the old classic through the rear view mirror, towards through the windshield. Now, a little bit of basics. When it comes to costing, direct costing is really ideal, and what I'm showing on this diagram is the highest form of direct costing really is project accounting, typically like in a law firm or a consulting firm or a make-to-order type of company. Then in the middle is where people mostly are, standard costing. If you're a manufacturer, you'll have some sort of, routings and bills of material. But understand, most of this really applies to the service industries, banks, insurance companies, oil and gas, and so forth. And then ABC is what I kind of call poor man's standard costing system. And we'll talk a little bit about ABC because that's where the consumption rates. But the real message here is on the right, we don't want allocations. Allocations, to me, is these broad averages which are violating the causality principle. So look at ABC. I know some of you are familiar with it. The quickest way I try to describe it is imagine you go to a restaurant with 3 other friends. And you order a little salad and the other order the most expensive item on the menu and a glass of wine. And when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not equitable. Well, that's how product costs also feel in a traditional general ledger system when the accountants take this large amount of indirect and shared expense and allocate it, peanut butter spread it, using the single, pools and broad averages like direct labor input hours, number of units produced, and so forth. It does not reflect the unique consumption that those products uniquely consumed of those expenses and the end-to-end processes and the work activities that belong to them. So to me, the simple definition is it's as if the waiter or waitress brings 4 individual checks. You pay for what you consume. And I'm going through ABC because we're going to need it when we get to the rolling financial forecast. What brought interest in ABC has to do with this diagram. Over the last 50 years, the indirect expenses have been displacing the direct, of the 3 universal components of any organization's expense structure. When you ask people why, well, they say, automation, machinery, and so forth. That's secondary. The primary reason for this shift is over the last 50 years, all organizations have an increased and disproportionate offering of many different types of products, customers, more colors, more sizes, more ranges. The point is this. Whenever you increase diversity and variation of your outputs, it just produces complexity. And complexity causes the need for more and more indirect support expenses to basically manage it. So, 50 ago, when an indirect was fairly thin, you could just basically include it and allocate it on the direct cost, no error. But when it's substantial, you basically need to have more visibility. Now, because most managers' primary view is those general ledger, cost center account responsibility statements. The question is, what about the process costs and what about the accuracy of the output costs? It actually begins with this statement, which almost everybody on the planet Earth, managers recognize the traditional cost center responsibility statement. The problem that when managers receive this report, they ask, well, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. I know what I spent, but I don't really know where it went and who basically made it happen. I always say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And it's not a problem with the report. The report's good, accurate. It's just the data is structurally deficient. What I mean by that is the data is not in a structure with which you can answer those other questions. So all that activity-based costing does is it reassigns that same $914,000 for this department into the language of work, verb, adjective, noun, and then it reassigns each of those activity costs to the products,